told you about a company that saw its net income soar from just $9.5 million to nearly $800 million in only 1 year.
Wow.
Yeah, that's not a typo, and it's exactly the kind of, financial turnaround that really demands a deep dive.
Absolutely.
So today, we're cutting through all the complexity to bring you the essential insights from EQT Corporation's second quarter 2025 results. We've pulled this straight from their detailed 10Q filing and their recent press release. And our mission really for you is simple. Give you a fast track to being well-informed about EQT's performance. We want you to understand the real drivers behind these, frankly, eye-popping numbers, their big strategic moves, and what it all actually means for their future. Okay, so let's unpack this incredible leap in financial performance that EQT experienced. For the 3 months ending June 30th, 2025, EQT's net income just exploded. $784.1 million.
Right.
That is, like I hinted, a massive jump from only $9.5 million for the same time last year.
It's almost hard to believe.
It really is. And if we zoom out, look at the first 6 months of 2025, their net income topped $1 billion. $1,026.3 million specifically, which is, again, a huge leap from $113 million in 2024.
And what's immediately striking about these, top-line figures is just the sheer magnitude of the shift. We also see diluted earnings per share, the EPS, climb dramatically from just 2 cents to $1.30 in the second quarter alone.
Wow.
And for the first half of the year, it's $1.70, up from only 25 cents last year. But it isn't just about profit, right? It's also about robust cash flow.
Okay.
Net cash from operating activities hit $1.2 billion for Q2. And for the first 6 months, nearly $3 billion. That's a really substantial increase.
Almost double the year before.
Exactly. Even their CEO, Toby Rice, he highlighted this. He talked about the, quote, differentiated earnings power of our low-cost integrated platform.
Sure. So the big question right away is, what exactly powered such a, dramatic increase in profitability and cash flow?
That's the billion-dollar question, isn't it? Almost literally here.
Right. And for you, our listener, understanding the why behind these numbers, that's where the real insight is. It means we're looking at a company that seems to be hitting its stride. And how they got there, well, that's the fascinating part. Let's start by looking at the core of EQT's business, how they actually generate their operating revenues, which, primarily comes from selling natural gas, liquids, NGLs, and oil. Okay, so looking at their overall production, total sales volume for Q2 2025 reached 568 billion cubic feet equivalent, BCEF.
Okay.
This actually hit the high end of their own guidance, and it marks a solid 12% increase from the same quarter last year.
That's decent growth.
Yeah, for the first 6 months of the year, that total volume was over 1.1 trillion BCEF, up from just over $1 trillion in 2024. And importantly, the average price they got, the realized price per McPhee, also saw a healthy bump. Rose from $2.33 to $2.81 in Q2.
Okay, so volume up, price up. That helps explain some of it. Now, digging a bit deeper into the specifics, natural gas sales volume in Q2 was about 534 billion cubic feet. A critical factor here, as you might expect, is the big increase in the average NYMEX natural gas price.
Right, the benchmark.
Exactly. It jumped from $1.92 per MMBtu in Q2 2024 all the way up to $3.43 in Q2 2025.
That's a huge difference.
It is. Now, interestingly, EQT did report what's called basis of negative 75 cents per McF in Q2, which means their local selling price was, 75 cents below that national NYMEX benchmark.
Which isn't ideal.
No, but here's where it gets clever. Their tactical curtailment strategy actually allowed them to optimize value, meaning they smartly held back some production. They avoided selling into those deeply discounted local markets, basically preserving value despite those tough regional prices.
Okay, so they didn't just flood the market when prices were low locally.
Precisely. A smart operational move.
That is clever. It's also worth touching on their liquids performance. For NGLs, excluding ethane, sales volume was up, but the average price actually dipped slightly. Ethane sales volume, on the other hand, went down, but its average price went up to $6.85 per barrel from $5.71 last year.
A mixed bag on liquids, then.
Kind of. And oil sales volume nudged up slightly, though its average price decreased a bit more significantly. But here's the real game changer, and this is absolutely pivotal to that stunning financial leap this quarter.
Okay.
The line item called gain on derivatives.
The hedging.
Exactly. This figure soared to an astonishing $719.9 million in Q2 2025.
Wow, from what?
From just $61.3 million in Q2 2024.
Okay, that's enormous.
It's huge. And this gain wasn't from selling more gas primarily. It was mostly due to increases in the fair market value of their financial instruments, their NYMEX swaps and options. And this was driven by decreases in the NYMEX forward prices.
Right, so their hedges, designed to protect against falling prices, actually generated a massive gain on paper as future price expectations dropped.
Exactly.
Yeah.
EQT uses these instruments like, an insurance policy or a financial bet to hedge their cash flows from gas and NGL sales. And because these aren't technically designated as cash flow hedges for accounting, the changes in their value get recognized directly in operating revenues.
So this nearly $720 million gain from derivatives, that was the single biggest driver of EQT's net income jump this quarter. Full stop.
It seems like it, yeah.
It really powerfully illustrates EQT's effective risk management through their hedging program. This strategy is designed specifically to protect cash flows from that wild commodity price volatility. And it's a sophisticated financial shield that, well, it truly delivered this quarter. It emphasizes just how critical these financial instruments are in a commodity business like this. It shows they're not just, drilling for gas, they're also very adeptly managing financial markets.
That's a great way to put it. Okay, so beyond the impressive revenue, and especially that derivative gain, EQT also showcased some really remarkable operational efficiency, particularly in managing costs. And they also restructured their business a bit for clearer reporting. For Q2 2025, their total per unit operating costs were $1.08 per McFay, which actually came in below the low end of their own guidance.
Fed control.
Yeah, and it's a noticeable reduction from $1.40 per McFay in Q2 2024.
So what drove that cost reduction? Any major factors?
Yes, absolutely. A major factor was a dramatic decrease in gathering expense. It plummeted from nearly $300 million in Q2 2024 down to just $48 million in Q2 2025.
Okay, why such a big drop?
It was primarily driven by EQT's strategic acquisition of those gathering, transmission, and storage assets.
Yeah.
Through the Equitrans midstream merger and getting more interest in the NEPA gathering system.
The vertical integration kicking in.
Exactly. By bringing these services in-house, they're essentially paying themselves for transport, allowing more internal movement. Now, counterintuitively, perhaps, transportation and processing to affiliate expense saw a huge increase.
Right, because now the affiliate is doing the work.
Precisely. But that's largely eliminated in their consolidated financials because of that vertical integration you mentioned.
Makes sense. Any other cost areas?
Yeah. Selling, general, and administrative, or SG&A, that expense also decreased. Mostly due to lower professional service costs and some adjustments after the Equitrans merger.
Okay.
Production taxes saw a slight overall decrease, kind of a mixed bag there.
Yeah.
Lower property taxes, but higher severance taxes due to more volume and higher prices. But other operating expenses increased notably, and this was influenced by higher legal and environmental reserves.
Right. You often see those fluctuate.
You do.
Yeah.
And you touched on this earlier, but here's a specific example impacting those other operating expenses. It included a significant one-time $133.7 million net expense. This was related to settling a securities class action lawsuit.
Ouch. That's a big hit.
Yeah, a substantial one-time item for both the 3- and 6-month periods ending June 30th. Also, this quarter marked a big strategic shift in how EQT actually reports its operations. They moved from just reporting as one single consolidated segment to now having 3 distinct segments: production, gathering, and transmission.
Okay. That follows logically from the Equitrans merger back in July 2024.
Exactly. And this change gives a much more granular view of their performance, lets you see each part of the business more clearly.
Yeah, and this internal restructuring and vertical integration, it's really a crucial part of the EQT's long-term strategy, isn't it?
Yeah.
By bringing these key functions like gathering and transmission in-house, they aren't just, cutting external costs. They're gaining much greater control over their entire value chain.
Right.
And that's the essence of their goal: creating this low-cost integrated platform, making sure they're efficient all the way from the wellhead to the market.
Absolutely. And EQT's recent performance, it's not just about tweaking existing operations. It's heavily shaped by several really bold strategic acquisitions and key partnerships.
Right. They've been busy on the M&A front.
Very busy. First, that Equitrans midstream merger we keep mentioning, completed July 22, 2024. A massive move. It involved converting Equitrans shares into EQT shares, 152.4 million EQT shares in total, valued at about $5.5 billion.
Mm-hmm.
And when EQT bought Equitrans, they naturally paid more than the book value of its assets. That difference is recorded as goodwill on the balance sheet.
Okay.
A big chunk of that goodwill, over $1 billion, was specifically linked to the future cost savings they expect. The synergies from bringing gathering and transmission in-house.
So it's a bet on future efficiency, not just buying existing assets.
Exactly. It's a bet on synergy. And this merger also brought direct financial impact, like the equity earnings from the Mountain Valley Pipeline joint venture. That contributed over $41 million in Q2.
Okay, so Equitrans was huge. What else?
Well, hot on its heels, EQT closed another significant deal, the Olympus Energy acquisition, on July 1st, 2025, so very recently.
Right.
This brought in about 90,000 net acres and around 500 million cubic feet per day of net production.
And how do they pay for that one?
A mix. Mostly EQT common shares, about 26 million of them, plus $500 million in cash.
Okay.
And what's impressive is how fast they say the integration is moving. They expect the majority of operations to be integrated within just 30 days of closing.
That's quick.
It is. And this Olympus deal directly influenced EQT's updated 2025 guidance. It led to a 100 BCF increase in their annual production guidance for the year and a 6-cent per McPhee reduction in their full year per unit operating costs.
Wow. So adding production but lowering unit costs. How?
They say it's all without increasing their 2025 capital spending plan due to offsetting efficiency gains elsewhere.
Interesting. Very efficient integration, it seems.
Seems like it. They also got pretty creative with financing through something called the Midstream Joint Venture, Pipebox LLC. This was formed with Blackstone Credit and Insurance right at the end of 2024.
Okay, how does that work?
Well, basically, EQM, which is an EQT subsidiary, contributed assets, including its share of the MVP joint venture. And in return, an affiliate of Blackstone put in $3.5 billion in cash.
Okay, so EQT gets cash now, Blackstone gets.
Blackstone gets the majority of the early cash flow from those assets, specifically 60% of the distributions until they've recouped their initial investment, plus a guaranteed base return.
Right.
After Blackstone hits that return threshold, EQT gets 100% of the cash flow until the 8th anniversary of the deal. Then it adjusts slightly, but EQT keeps almost all of it, at least 95%.
So it's a structured finance deal. Blackstone gets a preferred return early on.
Exactly. And in Q2 2025, $152 million in cash distributions went out to that Blackstone affiliate. There's still about $3.48 billion remaining until that base return target is achieved.
Got it. That's a clever way to raise capital without issuing more debt or equity directly.
Seems like it. Now, the Mountain Valley Pipeline, the MVP joint venture itself, that's another key piece that really started delivering.
Right, it finally came online.
Yes, it entered service mid-June 2024 and started its long-term firm capacity contracts on July 1st, 2024, with EQT actually operating it.
And they're looking to expand it too, right?
They are. EQT isn't stopping there. They're pushing forward the MVP Southgate project. That aims to deliver 550 million cubic feet per day down into the Carolinas, targeting completion in 2028. They've also launched what's called an open season for the MVP Boost project. That's designed to add another 500 million cubic feet per day of takeaway capacity from the basin.
So really leaning into the infrastructure they now control.
Absolutely. And to round out that regional control picture, EQT now holds 100% ownership of the NEPA gathering system after buying up remaining interests through 2024 and 2025.
Okay, so when you pull all this together, these complex deals, the strategic partnerships, it really paints a picture of how EQT is positioning itself for, sustained growth and market dominance.
Yeah.
They're not just expanding randomly. They're very strategically enhancing their control and their reach, especially within the Appalachian Basin, but maybe beyond too. They're really building an integrated energy giant.
It certainly looks that way. Now, with all these big strategic moves, these acquisitions, these JVs, you might be wondering, okay, what about EQT's underlying financial health? And where are they actually putting their capital?
Yeah, good question. All this activity costs money.
It does. Let's take a closer look. First, debt reduction. As of June 30th, 2025, their total debt stood at $8.3 billion.
Okay.
That's a solid reduction from $9.3 billion at the end of 2024.
So about $1 billion down in 6 months.
Yeah, and their net debt, which accounts for cash, decreased by about $1.4 billion from year-end 2024, reaching $7.8 billion.
That's significant deleveraging, especially while doing major acquisitions.
It is. They've been actively paying down that debt, repaid, redeemed, or repurchased over $800 million just during the first 6 months of 2025, including through tender offers for some older notes.
Mm-hmm.
And EQM plans to redeem its remaining outstanding notes, about $93 million worth, by the end of July 2025 using cash and their credit line.
Okay, so they're actively managing the debt profile. What about liquidity? Do they have cash available?
They do. Their liquidity position remains exceptionally strong. As of June 30th, total liquidity was a robust $4.1 billion.
That's a good cushion.
Yeah, and crucially, there were no borrowings outstanding under EQT's main $3.5 billion revolving credit facility at the end of the quarter.
Which really speaks to their strong cash generation, right?
Yeah.
They didn't need to tap the credit line.
Exactly. And EQT senior notes also hold investment-grade credit ratings from Moody's, S&P, and Fitch.
Which is important.
Very important. It's worth remembering that these credit ratings can directly influence their interest rates on debt, so maintaining them is key for keeping borrowing costs down.
Sure. Okay, so debt down, liquidity strong. What about future investments?
Yeah.
Capital expenditures.
Right, CapEx. For Q2 2025, their capital expenditures were $554 million. And impressively, this actually came in 15% below the midpoint of their own guidance.
Oh, really? So they underspent?
Yeah, which they attribute to efficiency gains. It's a strong testament to that.
Mm-hmm.
Total CapEx for the first 6 months of 2025 was $1.05 billion, which is actually slightly lower than the same period last year.
Okay.
And looking ahead, their full year 2025 guidance for total CapEx remains unchanged, reaffirmed at between $2.3 billion and $2.45 billion.
So they're disciplined on spending, but still investing heavily in the business.
Exactly. And for shareholders, EQT's board declared a quarterly cash dividend, 0.1575 per share, just recently on July 16th.
Okay.
And the company also has a substantial $1.4 billion still remaining under its share repurchase program as of June 30th. And they've extended that buyback program through the end of 2026.
So returning cash to shareholders, too.
Yes, dividends and buybacks.
You know, what's truly fascinating here is the careful balance EQT seems to be striking. They're undertaking these massive acquisitions, right? And maintaining substantial capital spending for future growth.
Mm-hmm.
Yet, at the same time, they're actively reducing debt and returning capital to shareholders.
It's quite the juggling act.
It is. It suggests a powerful belief in their ongoing operational cash generation, on a disciplined, strategic financial approach that aims to grow the business while also keeping investors happy.
Yeah, that makes sense. Okay, so EQT isn't just reporting on the past. They are very actively shaping their future and, of course, responding to the broader energy landscape.
Right. What's the outlook look like?
Well, their updated 2025 outlook now shows total sales volume guidance has been increased, now between 2,300 and 2,400 BCF for the year.
Okay, reflecting the Olympus acquisition, presumably.
Presumably, yeah. And projected full-year per-unit operating costs are expected to be lower by 6 cents per McV. Again, likely thanks to those strategic acquisitions and integration efforts. They also plan to turn in line, which just means bring into production between 95 and 120 net wells in 2025, with a good chunk of those scheduled for Q3.
Okay, so keeping the drilling program active, are they focused on anything else strategically?
Yes, very much so. They're heavily focused on something called in-basin demand growth projects.
Meaning finding local buyers for their gas.
Exactly, finding new customers closer to home in the Appalachian region. EQT is actively working to finalize agreements to supply gas for some major projects, like the 800 million cubic feet per day Shippingport Power Station and the 665 million cubic feet per day Homer City redevelopment project.
Big power plants.
Big power plants. They've also secured an agreement to be the exclusive provider of midstream infrastructure for West Virginia's first large-scale natural gas power plant.
Interesting. Locking up infrastructure deals, too.
Yeah, and they landed a third-party gathering contract to expand the Saturn pipeline system, also in West Virginia.
So this strategic shift towards growing local demand seems like a really key part of their future plan. Less reliance on long-haul pipes, maybe?
Could be part of it, yeah. Creating their own demand hub, in a way. Now, of course, like any large corporation, EQT faces some ongoing legal and regulatory matters we should mention.
Sure, always something.
There's a securities class action lawsuit still pending from back in 2019. It alleges materially false statements related to the 2017 Rice Energy merger. Plaintiffs are seeking unspecified damages there.
Okay.
There's also something called the Pratt Storage Field matter. A criminal complaint was filed in October 2023 over alleged violations of Pennsylvania's Clean Streams law. This relates to a gas explosion way back in 2018.
Mm,
This carries a potential fine over $300,000, and the federal energy regulators, FERC, have given them an extension until early 2026 to plug a specific well related to that incident.
right. Legacy environmental issues can linger.
They can, and in the broader political context, we should note, impartially, of course.
Of course.
President Trump signed the One Big Beautiful Bill Act into law on July 4th, 2025.
Good.
EQT has simply stated it is currently evaluating the potential tax impacts of this new act on the company. We don't have details yet.
Right. Too early to say what that means for them specifically.
Exactly. And more broadly, EQT just acknowledges, as most companies do, that a changing regulatory environment or domestic or foreign tariffs, those things could impact the demand for and the price of natural gas, their revenues, and their expenses.
Sure. The standard caveats. But it does bring up a crucial question, doesn't it? How will these new projects, the ones designed to capture that in-basin demand and this evolving regulatory and political environment, how will all that impact EQT's ability to keep up this strong operational performance and growth trajectory?
Yeah.
It's clearly a dynamic landscape out there, and their strategic positioning, this integrated model they've built, it really appears to be a crucial element in navigating whatever comes next.
Absolutely. Well, what an incredible deep dive into EQT's second quarter. We've really seen how they've leveraged those strategic acquisitions, the operational efficiencies, and clearly a very keen eye on market dynamics, especially those huge derivative gains, to achieve truly remarkable financial results.
Yeah.
It really feels like a masterclass in navigating a pretty volatile industry.
I agree. The blend of increased production volumes, those incredibly shrewd financial hedging strategies that capture just massive gains, and a clear vision for integrated growth right there in the Appalachian Basin. It's compelling. It demonstrates how a company can not only adapt but actually thrive, even when you've got volatile commodity prices and a complex, ever-changing regulatory environment.
So thinking about all this, what will you, our listener, be pondering after this deep dive? Perhaps it's how companies like EQT manage that really intricate dance. The dance between aggressive growth through acquisition on one hand and maintaining rigorous financial discipline on the other. Especially when you're faced with shifting market dynamics in an evolving policy landscape like that new tax act.
Yeah.
It's just a powerful reminder, I think, that truly understanding a company's success often means looking beyond just the headline profit numbers. You have to dig into the granular details of their operational strategies, the real impact of their big strategic plays, and their ability to adapt to all those external forces.